From the late 1990s to recent time, the pace of mergers and acquisitions has risen to unprecedented levels. The market shares, excess production capacities, valuations of businesses are among the many reasons for mergers and acquisitions. Merger and acquisition involves the joining of two companies, but the process of doing so can be very different. A merger occurs when two separate companies combine their operations to form a new company. On the other hand, an acquisition refers to the takeover of one company by another, such as hostile takeover in some extreme cases. Mergers and acquisitions are carried out for many reasons, which may include gaining market share to create monopolistic market control. Second, increasing shareholder value is a key motivation behind mergers and acquisitions. Third, expanding a company's stronghold for its long-term survival. Some merger and acquisition brought successful stories. However, many studies reported that 2/3 or about 70% of mergers were failures, as they did not earn the required cost of capital for the product-related activity involved. For example, it was reported that in year 2000, British multinational telecom company Vodafone Group acquired German telecom giant Mannesmann AG for about $180 billion. The objective for the merger was to gain market share across the globe and to reshape the global telecommunications landscape. But the deal was later found to be a failure, and Vodafone was forced to write off billions of dollars in the following years. Another example of merger involves American Online, AOL, when it acquired Time Warner for $166 billion in January 2000. In a report by Investopedia, the internet provider, AOL, made a bid to acquire mass media conglomerate, Time Warner, and at that time AOL had a massive market share and was looking to expand even further by tapping into Time Warner's dominance in publishing, entertainment, and news. However, the expected synergies of the merger never fully materialized. The two companies clashed in management style and culture, something that was only exacerbated by the bursting of the dot-com bubble and the ensuing recession. The value of AOL stock clashed significantly, and eventually both AOL and Time Warner went separate ways to operate as independent companies. Next example involved Dow Chemical acquired DuPont in 2017, when the two chemical conglomerates, Dow Chemical and DuPont, merged at $130 billion. The combined companies became Dow DuPont Inc. and included three divisions: agriculture, materials, science, and specialty products. However, in 2019, Dow DuPont broke up into three companies: Dow Chemical, DuPont, and Corteva. Dow Chemical is a commodity chemical company and DuPont is a specialty chemical maker. Corteva is an agricultural company producing seeds and agricultural chemicals. Mergers and acquisitions in the corporate world are very common nowadays, but not all of them lead to success. As mentioned earlier, more than 70% of merger and acquisitions failed. This is a depressing stat for business leaders to read. Some of the biggest disasters in mergers and acquisitions are attributable to multiple factors that may or may not be under the direct control of the entities involved. These include internal issues like cultural integration between the two companies, or macro-level problems like overall economic conditions and geopolitical issues. It is critical for entities involved in any merger and acquisition to manage well the integrating and merging activities during the initial mergers and acquisitions phase, also known as post-merger integration (PMI) program. The equation 1 + 1 = 2 often symbolizes the expected outcome of mergers and acquisitions. Post-merger integration (PMI) is necessary for an acquiring company to implement various integration programs to ensure financial and operational success in as short time frame as possible to realize the company's acquisition objectives. There have been numerous cases that companies experience setbacks operationally and financially as these companies are not able to manage well the integration activities, or on some occasions, They leave the merger activities to natural flow due to lack of structural and systematic follow-up programs. Therefore, a simple equation of 1 + 1 = 2 does not work in most of the acquisition situations. Many acquisitions ended up in failures which not only affect the new company's business performances, but also bring down the staff morale. Below are some examples of post-merger integration, PMI programs. Example 1, when one merger entity exceeds management control for a fixed and guaranteed return based on the share of equity or other basis. This tends to work when one entity company is significantly more dominant than the other entity partner, be it financial or technical advantages. With the passive partner at play, the other shareholder can implement more freely the structural changes to help steer the company to achieve the defined directions or visions. Another example is 100% acquisition of one company by another entity. The acquiring entity has 100% control over the operations of the company, but requires significant efforts to integrate the acquired entity into the group's business systems and corporate culture. Usually more team members are placed for critical functions to drive organizational changes. The next example is for a joint venture company board to appoint each respective key management positions in the company with regular board meetings to review the company's performances. PMI managers must be an all-rounder and with good support from the corporate shareholders to implement some changes at the new company. This requires significant efforts from the position holders and might take more time to effect changes. The position holders should also be given high corporate responsibilities and accessibility to C-level leaders, as there is tendency for middle and low level to refuse changes, given that nobody wants to be a bad guy in a typical real-world setting. Implementing open communication and appropriate HR policies should be in place to ensure employees' morale and work performance while the new company is undergoing changes. This presentation is for entertainment purposes only, and professional advice should be sought.